Previously on DIY Wealth.
If you actually just add the amount of monthly inflation we've been seeing to the current CPI, that yearly inflation number, it trends down. We are starting to see signs that inflation, especially for different products, oil for example, is starting to trend down. In the coming months, inflation is going to go down to 4.32%.
So, not to toot my own horn, but I called it. If you check out some of my previous content here and here, you'll see that I pretty accurately predicted where inflation was going to go down to the decimal point. And as you can see from this newsletter excerpt that's published on patreon.com/DIYwealth, I predicted a year ago that inflation by August 2023 was going to drop to 2 to 3.2%. And sure enough, by August 2023, we saw that inflation had gone down to that amount. So, boom! Eat that, doom and gloomers. Everybody was telling me that I was a complete nut for actually thinking that inflation was going to go down. Everybody was like, oh, we're about to enter hyperinflation. And none of the data actually lined up with that. And because inflation fell faster than anybody expected it to, my prediction about what would happen to stocks in early 2023 came true too. I said that disinflation was going to be bullish, and guess what? It was. I didn't use a crystal ball or anything. I just looked at the data, I looked at some studies, and I just made an assumption that what was going to happen would probably resemble what has happened in the past. And that was the basis for all of my predictions from my past videos that you can probably check out here if you feel like it. So now we're at a fun little juncture because we have to ask the question, is the Fed done with its inflation fight? Is inflation done forever? Is it going to get worse? Are we going to see inflation up, down, up again? The answers to these questions are a little nuanced, and if you want to understand what's going to happen to inflation in the future, we probably have to understand what inflation even is. And so that's what I'm going to do in this video. I'm going to explain what drives inflation up, I'm going to explain what drives inflation down, I'm going to explain how inflation affects stocks, I'm going to explain how inflation affects the economy, and ultimately by the end, I'm hoping that I'm going to be able to give you a pretty decent guide about how to comport yourself and change your portfolio and invest when inflation is on the horizon or not. Because truth be told, inflation affects everything from your job to your paycheck to your ability to pay the bills to your retirement portfolio. But what I don't want this video to be is another typical hyperbolic, this is clearly what's going to happen to inflation. This is clearly everything is going to die. Oh no, the catastrophe. No, the goal of this video is simply to help you understand what inflation even is so you can make more informed investing and wealth building decisions for you and for your family. So if you're cool with that, let's get started. Hi, I'm Sean McIntyre, your personal wealth pilot. For the duration of this video, please keep your tray table stowed and your wealth building seats in their upright and locked position. So screw the YouTube algorithm really quick. Let's just dive right into it and ask ourselves, what even is inflation? So here's the truth of the matter. Inflation is actually a pretty poorly understood phenomenon. We've only been measuring and studying inflation for the last 100-ish years. There's some nuance to that, but that's when the CPI, the Consumer Price Index, was actually invented. And a lot of the central bank policies surrounding interest rates and tying them to the rate of inflation only go back so far as the late 80s and early 90s. And in fact, if you look at the papers and the books that economists actually publish, there are two unanswered questions that we still don't know about inflation. For one, we don't actually know what measure of inflation most accurately represents the changing pricing power in an economy. And second, we don't actually know what level of inflation is most appropriate for a modern economy. So I want to caution you, when you hear the news or when you see things on the mainstream media about inflation going crazy, the story is much more complicated than that. The truth is, many policymakers are just custodians to a system that they don't really fully understand. Now, you can view that as permission to distrust and ignore policymakers, as many do, or you can view what I just said as a call for empathy for policymakers and economists because they're working with incomplete information and doing the best that they can. With all that said, when most people think of inflation, they think of what they see in headlines and in the news, this number. And if you look at that number, at this particular point in time that I'm recording this, it looks like it's dropping, right? It looks like everything's getting back to normal in the old United States and stuff like that. But here's the thing, that's not what inflation actually is. What you're seeing is really just the difference between an index of things now and what it was like a year ago. Inflation in absolute terms actually looks like this. This is called the Consumer Price Index. It measures the relative price of basically a basket of different things that people buy, like rent and cigarettes and sausages and cars and paint. I guess paint. Economists look at all these different prices and then just like smoosh them together into this one number. But if you actually dig into the numbers and look individually at the different products that are driving inflation up and down, it actually looks more like this. Every month, prices are changing, prices are going up, prices are going down. Things vary from place to place. Ultimately, the purchasing power of your dollar depends on the things that you buy and the things that you consume. And if you look at the long-term history of prices in the United States, what you see is that actually certain prices have inflated tremendously while some prices have deflated tremendously, meaning that your purchasing power of your dollar has actually gone up for certain things. So while things like school tuition, medical care, housing, all those things have seen tremendous inflation over time, the overall average of inflation is being brought down by other goods that have gotten cheaper and cheaper as a result of more efficient and more innovative production processes. Things like televisions, software, communications equipment, things like that. Like, can you imagine like trying to build an iPhone in 1937? No amount of money in the world could have actually accomplished that. So the prices come down pretty significantly over the last 100 or so years. Another way to understand this is that if you are just a regular person and most of your money is being spent on tuition, food, gas, medical care, the things that you're going to be spending more on, over the course of your life once you get into your like 30s and up, well, your dollar can buy about 80% less of that stuff than it could about 50 years ago. But if you're a weirdo who lives in the woods and you've been driving the same car since 1970 and all you do is buy women's blouses, cell phones, and LCD television screens, your purchasing power has gone up tremendously. A little parenthetical here. This is one of the reasons why you should be a little distrustful of any chart that says something is inflation adjusted, because again, purchasing power is not only differing from region to region, it differs from person to person and what they consume. So these averages and the things that you do to correct these averages over time, deeply problematic, and they don't give you a full sense of what is happening in an economy, especially at an individual level, like to you. Okay, so that's what inflation is, or at least one measure of it. But in order to fully understand inflation, we have to ask ourselves a simple question. What makes inflation go up or down? And really, there are three drivers that move inflation in any sort of significant way. Money supply, major changes to productivity or resource availability, and third, corporate whim and caprice. When it comes to money supply, we're really talking about the actual available amount of money in an economy, just the dollars that are floating around from institution to institution and person to person. The more money floods into an economy, the more we tend to see periods of inflation increasing. So there are two primary drivers for the amount of money that's floating around in the economy. One of them is like the Fed money printer, which is actually just bank lending, and the Fed changes that or affects that by setting parameters for what the interest rate should be. Like the Fed money printer isn't a printer at all. It really is just like a sliding scale for a bunch of nerds. And the other driver for money supply is fiscal policies. That is like actual government spending on stuff like NEA grants and pies for veterans. I don't know what the government spends money on. The other big driver for inflation is changes to productivity. And what causes that? It's availability of resources, it's technology, it's innovation that allows for some jobs to be done faster or more efficiently so you can get more stuff for less actual capital input. Societal dysfunction is a big one. Like a society is not productive if everybody's going on strike. War is a big one. Like if you bomb a whole country's factories, they aren't able to make stuff. But in general, things that increase productivity tend to be deflationary, like they pull inflation down because you can get more stuff for cheaper. And stuff that decreases productivity tends to make inflation go up. And the third big driver of inflation that a lot of people don't really talk about very much is like corporate capriciousness. Like, let's be real for a moment. Businesses and people have a choice about what they price things at. And so if you want to actually understand inflation now or like 10,000 years in the future, really like the period from 2020 to 2023 is a really good microcosm of like everything that could happen to make inflation go up. There was a lockdown, and so productivity disappeared, but then lockdowns released, and so there was all this pent-up demand, and that massively exceeded supply, and so people couldn't productively ramp up fast enough to keep up with that demand. Hence, prices went crazy. Then there were a bunch of supply chain backgrounds which caused input costs to go up, which means that business expenses went up. So, naturally they want profits, so they pass those profits on to people like you. There was also a bunch of money dropped into the economy in the form of cash stimulus and PPP loans and other crazy, insane government spending. Just look at this chart of the amount of money that was injected into the economy in 2020. It was absolutely insane. And it stands to reason that inflation resulted from that. There's also a bunch of debt issued, and lending was really cheap because interest rates were really low. And of course, businesses decided to hike prices because they could. In fact, according to research done in 2022, about 53.9% of the inflation that we saw in 2022 could be attributed directly back to just companies wanting to charge more and knowing they could get away with it. So if you see any of those things happening again at some point in the future, you probably know that there's going to be another inflation storm coming. So now that we know what inflation even is, what generally affects it, we can ask another question, which is how does the Fed and interest rates even come into play here? How do Fed interest rates help lower inflation? What do people mean when they talk about Fed interest rates? So the federal funds rate is just the interest rate that banks charge to each other for very short-term loans. So by law, banks have to hold on to a certain amount of cash or cash equivalents, that's usually US Treasury bonds, in reserve to cover some proportion of the actual checking accounts and other accounts that they have on their file. This is commonly called fractional reserve banking, and it's been working kinda for the last 100 years. I mean, certainly to make the rich get richer. So any money that a bank has in their Fed account in reserve that exceeds what they're legally required to do, they're allowed to lend that to other institutions, and they just swap money all the time. Usually it just happens overnight. And if you loan money to a person or an institution, well, you get to charge a little bit of interest, and that's what the Fed interest rate actually is. And while that interest rate is largely determined by market forces, the Fed tries to set a parameter, an upper and lower bound. It's called the target rate in reality. But because this target rate affects how much banks can actually get from their excess reserves, ultimately this affects bank profitability, which means that it also affects credit card rates and mortgage rates and other loan rates. Also certainly affects bond rates because, listen, if you can just get a ton of money from, doing these reserve swaps, then, why would you need treasury bills? You could just sell those, but when you sell a treasury bill, their interest rate goes up, which makes them more attractive. It's a complex adaptive system. Economics is weird. But earlier in this video, I mentioned that loans and debt create money in an economy. And so ultimately the Fed interest rate, by going higher, what that does is it makes debt more expensive, which means that people are less likely to take on debt. And so the Fed interest rate going up works to decrease inflation because it sucks some money out of the economy, or at least banks' willingness to put more money into an economy. Now that's important, keep that in mind because we're gonna come back to that later. So unless you've been living under a rock, you know that the Fed in 2022 went on the warpath raising interest rates to try to fight inflation. And they did that in order to regain control of pricing parity in the United States. And as you can see, they raised interest rates at a faster clip than basically any other time in recent history. And by mid-2023, the Fed has slowed down its rate increases. They're still going up at the time that I am recording this, but by the time you watch this, the Fed interest rates might actually be going down. And they would only be going down if there is some problem or if the economy cannot sustain these higher costs of debt, and actually we're starting to see a risk of deflation as a result. But the Fed would only slow down its rate of interest rate increases if inflation were actually coming down, as I mentioned at the beginning of this video. But it isn't all good news, and in fact, we could probably at this point in time expect further increases in the federal interest rate simply because inflation is probably going to go up again for reasons I'll explain in a moment. In fact, the chairman of the Fed, Jerome Powell, even had this to say. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down closer to 2% over time. What he meant was that the Fed projects that the economy is strong enough and inflation is still high enough that the Fed is going to have to increase rates more. And that's actually going to be probably a little bad for stocks. Anyway, that means that mortgage rates are probably going to go up, which is going to like suppress housing prices a little bit or just put more pressure on them. The cost to borrow is going to go up. Loans will be fewer and far between. It'll be harder for financial businesses to get people to refinance bad debt. That can cause a lot of bankruptcies and, of course, naturally, probably a sell-off in stocks. And based on where the Fed is right now, we're probably not going to see rates actually decrease until like 2024, maybe 2025. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Read between the lines of what Jerome Powell just said. You know what can cause a softening of labor market conditions? An economic recession. But why? Why is the Fed basically promising that they are going to drive the economy into a recession until inflation is under control? Well, all you need to do is rewind this video and go back to what I said actually drives inflation up or down. Is the Fed able to just go to companies and tell them to lower their prices? No. Can the Fed print factories, drill new mines, create like magical productivity increasing technologies? No! Can the Fed force the US government to stop creating more debt due to deficit spending? No, the Fed right now has no authority or ability to control the things that are actually causing inflation right now. They have the ability to make it harder or easier for banks to lend to each other, but that's it. And here you could probably intuit another major problem with this inflation scenario that we are currently in. At the present moment, Jerome Powell is treating the inflation here like it was the same as the inflation from the 1970s. So what do we have right now? We have a ton of public debt and we have really, really high government deficits. But the inflation we saw in the 70s, we didn't have super high public debt. We didn't have crazy deficits. In fact, what we had was a problem with too much bank lending. But despite that fact, the Fed has been increasing interest rates even though it's still not chopping at the root of the problem that we are currently facing. And that's led to a weirdly counterintuitive situation. The amount of money in the US economy is actually declining, but inflation is still going up. You don't need to be an economist or an analyst to look at that fact and go, there's something very wrong here. And the actual impact of that could be maybe devastating for unprepared investors. So if gun to head, I had to make a prediction about what we were going to see in the near future, it would be this. The combination of high government debt, high government spending, and supply constraints is probably going to cause a very volatile economic situation in the US for the next 10 years. The economy is generally going to bounce between inflation and stagnation, and this is probably going to lead to ultimately probably pretty below average long-term returns for most major stock indices like the S&P 500, but also in nations like Japan or the EU, companies that are publicly traded in those areas. Basically, we should expect another reckoning in the stock market. I don't know when it's going to be, but it's probably going to be within the next few years. And if I had to guess, and I really hope I'm wrong here, I have a feeling the next 10 years is going to be what's called a lost decade for stocks in the United States. A lost decade is just a 10-year or longer period where stocks basically go nowhere, where if you buy at one point, you wait 10 years, and even with dividends reinvested, you basically have made no money. But there's typically a lot of up and down in between. A good example of this is the period from like 1969 to 1980, where major inflation issues and supply chain issues caused the US stock market to wildly go up and down for over 10 years and basically ended up nowhere. Like there was barely any return over that period of time. 2000 to 2013 was another one of those lost decades where you definitely saw periods of where the stock market went down, then it went up, then it went down, then it went up. And the people that tend to be most harmed by these situations are your growth stock investors, your tech stock investors, your traders, your momentum investors, the people that are more risk on. Unless something changes, those people are going to be on a roller coaster for the next 10 years, and they're probably going to be no richer for it. The best way to increase the odds of getting a positive stock market or any sort of asset return during this period is to do that old investee thing, buy low and sell high. And guess what? You can only really buy low after stocks have tumbled and dropped down a little bit. And that, for most people, is a really scary proposition. Most people don't like to invest after the market has been going down, even though that's the best time to invest. So long story short, yeah, we're probably going to see inflation hover above where we want it to be for an extended period of time. Yeah, we're probably going to see the Fed hike interest rates some more. Yeah, we're probably going to see a recession some point in the next few years. And yeah, once that happens, we're probably going to see the Fed lower interest rates and start to stimulate the economy again. But also, yeah, as a result of that, because debts and deficits are still very, very high, that's probably just going to give us another bout of inflation that we just saw in 2022. And it's for all of those those reasons that I just listed that in all likelihood, the next 10 years-ish or so, we're probably not going to see a whole lot of growth in your standard fare stock market kind of stuff. It's just going to go up and down. But listen, there's plenty of stuff that you can do over the next few years to ensure that this is not going to be a lost decade for you or your family. One simple example is just buying high quality stocks when they dip in price. That's how Warren Buffett earned crazy returns in the 1970s. Is how he earned crazy returns in the 2000s. And just think, don't you personally wish you could go back in time to like September of 2022 when like the market was absolutely tanking and buy? Like you would have made so much money over the next few months. And what was I saying on this very channel back in like September, October of 2022? I was saying buy stocks, buy stocks. The risk reward for stocks still was like very attractive. I was telling you to do that. Now might not be the time to be buying stocks, or at the very least, make sure that you're very careful about the stocks that you buy. Remember, the best time to buy stocks is usually when nobody else actually wants to buy them. So keep that in mind, and you should do fine. And if you want more information, tips, guidance, advice on what you should do or how you can grow your wealth, make sure to check out this video next. Thank you for watching the video all the way through. If you like this video, don't forget to like and subscribe to our channel. And if you thought, oh, I would like to become more financially literate, I want to learn more about investing in detail, well, then check out my newsletter, The Legacy Wealth Monthly. You can click the link in the description box below. With the concept of becoming richer every month, Legacy Wealth Monthly is packed with information necessary for asset building through investment, and includes recommendations of individual stocks and commentary on current market conditions. Legacy Wealth Monthly also features a column from Mark Ford, a multimillionaire who built his fortune from an ordinary salary to 5 billion yen in just a few years. You'll also find editorial by a Japanese analyst and a Q&A corner to answer your investment questions. We provide you with lots of information, all with the goal to enrich your life. If you are interested, please check out the details in the description box below. Take care.